Chinese billionaires are quietly dumping $50 billion in US assets right now. Real estate, treasury bonds, corporate securities, they're selling everything. This isn't normal market activity. In 2012, China held $1.3 trillion in US treasuries. Today, it's down to $760 billion, the lowest level since 2009. That's a 40% reduction over just one decade. The same pattern happened before every major conflict in history. Before World War I, German elites moved their wealth out of London banks. Before World War II, Japanese investors pulled money from American markets. Before the Cold War escalated, Soviet-connected funds disappeared from Western financial systems. And here's what should terrify you. This isn't about economics or trade wars or market cycles. Chinese financial elites are sanction-proofing their wealth because they know something is coming. They're preparing for a conflict over Taiwan that could trigger the largest financial war in human history. And they're positioning their money before ordinary Americans even realize what's happening. Subscribe, because when the financial war starts, you'll want to understand how the wealthy protected themselves while everyone else got blindsided. The financial world operates on signals that most people never see. But when Chinese billionaires begin systematically liquidating $50 billion worth of American assets, the message becomes unmistakable. This is not the routine portfolio rebalancing that financial advisors discuss in polite company, nor is it the natural ebb and flow of international capital markets that economists cite in their academic papers. This represents a fundamental rupture in the financial architecture that has dominated global economics for over 2 decades, a deliberate and coordinated withdrawal from the very foundation of American monetary supremacy. Since the early 2000s, the mechanics of global finance have followed a predictable pattern that enriched both Chinese exporters and American consumers, while creating dangerous dependencies neither side fully understood. Chinese manufacturers would sell goods to American buyers, accumulating vast surpluses of dollars that needed to be invested somewhere safe and profitable. Those dollars flowed directly into American Treasury bonds, government-sponsored agency securities, and real estate markets, creating what appeared to be a mutually beneficial cycle. China received steady returns on safe investments, while America enjoyed artificially low interest rates and inflated asset prices that made homeowners feel wealthy and politicians look successful. This arrangement formed the backbone of what financial elites privately called the dollar recycling system, a mechanism that allowed the United States to maintain massive trade deficits without suffering the typical consequences of living beyond its means. Chinese trade surpluses essentially subsidized American consumption and government spending, creating an illusion of prosperity that masked the growing imbalances threatening both economies. The system worked beautifully, as long as both parties maintained their roles and trusted that political tensions would never escalate beyond manageable trade disputes. The current liquidation reveals that trust has evaporated entirely. Chinese financial elites are not responding to market conditions or seeking better investment returns in alternative markets. They are implementing what intelligence analysts recognize as a classic sanction-proofing strategy, systematically moving wealth beyond the reach of American financial weapons before those weapons are deployed. The timing cannot be coincidental when tensions over Taiwan have reached levels not seen since the 1990s, and American politicians from both parties increasingly view economic warfare as preferable to military confrontation. Understanding this withdrawal requires recognizing how dramatically the geopolitical landscape shifted after 2022, when Western nations demonstrated their willingness to freeze Russian assets, exclude Russian banks from international payment systems, and essentially weaponize the global financial infrastructure against any nation deemed threatening to Western interests. Chinese leadership observed these sanctions with particular attention, recognizing that their own economy remained far more integrated with American financial systems than Russia ever was. Trillions of dollars in Chinese wealth sat exposed within American legal jurisdiction, vulnerable to the same freeze orders that neutralized Russian oligarchs overnight. The $50 billion figure represents only the visible portion of a much larger strategic repositioning. Chinese state-connected funds, private equity groups, real estate investment vehicles, and individual billionaires are all participating in what amounts to the largest coordinated capital flight in modern financial history. They are converting dollar-denominated assets into gold, alternative currencies, and investments outside American legal reach, preparing for a scenario where economic ties between the world's two largest economies are severed completely. This is not speculation about distant possibilities, but preparation for conflicts that Chinese elites clearly believe are inevitable, making their current actions the equivalent of moving gold out of a besieged city before the siege begins. The numbers tell a story that financial media refuses to acknowledge, revealing a systematic withdrawal that has been unfolding for over a decade, while American economists insisted everything remained normal. At its peak around 2012 and 2013, China reportedly held as much as $1,320 billion in United States Treasury securities, making it the largest foreign creditor to the American government and a crucial pillar supporting the entire dollar-denominated debt system. This massive accumulation represented the ultimate validation of American financial supremacy, proof that even potential rivals viewed dollar-based assets as the safest store of value in an uncertain world. The subsequent decline tells a different story entirely. Official data from early 2025 reveals Chinese Treasury holdings have fallen to approximately $761 billion to $784 billion, levels not seen since 2009 when global financial markets were still recovering from the subprime mortgage crisis. This represents a reduction of roughly 40% over just one decade, a contraction so significant that it defies every conventional explanation offered by mainstream financial analysts, who continue to frame this retreat as routine portfolio diversification. Mathematical precision reveals the calculated nature of this withdrawal. China did not reduce its treasury holdings in response to specific crises or market events, nor did the selling accelerate during periods of particular diplomatic tension. Instead, the reduction followed a steady, methodical pattern that suggests long-term strategic planning rather than reactive decision-making. The consistency of this drawdown indicates that Chinese financial authorities established target reduction levels years in advance and systematically worked toward those goals regardless of short-term market conditions or bilateral political developments. This timeline directly contradicts the safe asset theory that forms the foundation of modern monetary economics. According to conventional wisdom, countries accumulate treasury securities precisely because they represent the ultimate safe haven during times of uncertainty and geopolitical tension. If Chinese leadership truly viewed American government debt as a reliable store of value for their massive dollar reserves, the logical response to increasing tensions would have been to maintain or even increase their holdings, not systematically reduce them over an extended period. The scale and duration of this retreat reveals something far more significant than temporary concerns about interest rates or currency fluctuations. Chinese financial strategists clearly concluded that the risks of holding American debt now outweigh the benefits, fundamentally altering a relationship that provided stability to global financial markets for over 2 decades. This decision required abandoning the security of known returns and predictable liquidity in favor of alternatives that necessarily carry higher risks and greater complexity. Understanding the implications requires recognizing that Treasury securities serve multiple functions beyond simple investment returns. For foreign central banks and sovereign wealth funds, these holdings represent diplomatic leverage, crisis insurance, and proof of commitment to the existing international financial system. When a major economy systematically reduces such holdings, it signals a fundamental loss of confidence, not just in American fiscal management, but in the entire architecture of dollar-based global finance. The timing reveals additional layers of strategic calculation. Chinese authorities began this reduction well before recent tensions over Taiwan reached current levels and before American politicians began seriously discussing financial sanctions as weapons of statecraft. This suggests that Chinese leadership anticipated the weaponization of financial systems years before it became obvious to Western observers, positioning their economy defensively while maintaining the appearance of normal economic relations. The current acceleration of this trend indicates that whatever timeline Chinese strategists originally established has now been compressed, suggesting that events they prepared for over the long term may now be expected much sooner than originally planned. The strategic calculus governing international finance changed permanently in 2022 when Western nations demonstrated that the global financial system could be weaponized against any nation deemed threatening to Western interests, transforming what had previously been viewed as neutral economic infrastructure into instruments of geopolitical warfare. The coordinated response to Russian military actions revealed capabilities that financial strategists had theorized about for decades, but never witnessed deployed on such a massive scale, fundamentally altering how every major economy evaluates its exposure to dollar-denominated systems and Western-controlled financial networks. Russian assets worth hundreds of billions of dollars were frozen overnight across multiple jurisdictions. Russian banks were expelled from the Society for Worldwide Interbank Financial Telecommunication Messaging System, and entire categories of Russian financial institutions found themselves unable to access international payment networks that had operated as neutral utilities for decades. These actions demonstrated that the apparent neutrality of global financial infrastructure was an illusion, and that access to dollar-based systems could be revoked instantly for political reasons, regardless of existing contracts, legal agreements, or historical precedent. Chinese leadership observed these developments with particular attention because their economy remained far more integrated with American financial systems than Russia ever was, making their potential vulnerability exponentially greater. Trillions of dollars in Chinese wealth sat within American legal jurisdiction, subject to asset freezes, court orders, and regulatory actions that could be implemented faster than Chinese authorities could respond. Unlike Russia, which maintained significant financial independence through energy exports and limited integration with Western banking systems, China had spent decades building deep dependencies on dollar-based trade finance, treasury markets, and American real estate investments. This exposure became particularly concerning as analysts of Chinese financial security began routinely citing vulnerability to foreign sanctions as a core national security threat, recognizing that economic warfare could potentially inflict more damage than conventional military conflict, while avoiding the escalation risks associated with direct military confrontation. Chinese financial authorities understood that their massive accumulation of dollar-based assets, previously viewed as prudent diversification and evidence of economic integration, had become a strategic liability that hostile actors could exploit during any future crisis. The internal vulnerabilities facing China during 2024 and 2025 amplified these concerns significantly. The Chinese real estate sector, which had served as a primary driver of economic growth for over 2 decades, entered a severe crisis with major developers defaulting on obligations and property values declining in major metropolitan areas. Corporate debt stress spread beyond the real estate sector as companies struggled with overcapacity, reduced demand, and tightening credit conditions. Foreign investment flows, which had provided crucial capital and technological transfer for decades, declined sharply as international corporations reconsidered their China strategies amid rising geopolitical tensions. These domestic pressures created powerful incentives for Chinese elites to move wealth beyond the reach of potential sanctions, while such movements remained legal and politically feasible. Holding trillions in American assets during a period of increasing bilateral tensions represented an unacceptable risk for individuals and institutions with advanced understanding of geopolitical dynamics and monetary leverage. The value proposition of dollar-based investments fundamentally changed when the potential returns had to be weighed against the risk of complete asset loss through political action rather than market forces. The psychology driving this capital flight reflects the strategic thinking of financial elites who understand that the next major conflict between the United States and China would likely be fought primarily through economic means rather than conventional military action. Taiwan represents the most probable trigger for such a conflict, and Chinese financial strategists recognize that any military action in the Taiwan Strait would immediately result in comprehensive financial sanctions designed to cripple the Chinese economy through isolation from dollar-based systems. Moving wealth outside American jurisdiction before such a crisis emerges represents basic financial survival planning for individuals and institutions sophisticated enough to anticipate these developments. The liquidation of American Treasury securities represents only the most visible layer of a far more comprehensive withdrawal that extends deep into private asset markets, real estate holdings, and corporate investments that Chinese entities accumulated over decades of seemingly profitable integration with the American economy. This broader sell-off reveals the systematic nature of the current retreat, demonstrating that Chinese financial strategists are not simply adjusting their sovereign debt exposure, but fundamentally restructuring their entire relationship with dollar-denominated assets across every major category. American real estate markets have served as a particularly attractive destination for Chinese capital since the early 2000s, when Chinese individuals and corporations began acquiring residential properties, commercial buildings, and development projects across major metropolitan areas. These investments appeared to offer multiple advantages, including portfolio diversification, inflation protection, and access to stable rental income streams denominated in the world's reserve currency. Chinese buyers became significant players in markets from Manhattan to Silicon Valley, often purchasing properties at premium prices that reflected their confidence in long-term American economic stability. The strategic environment that made these investments attractive has now reversed completely, transforming valuable assets into dangerous liabilities that expose Chinese wealth to potential confiscation through legal mechanisms that could be activated rapidly during any future crisis. American real estate holdings cannot be moved offshore quickly or converted into alternative forms without substantial transaction costs and regulatory scrutiny. Unlike financial securities that can be sold electronically and converted into other assets within days, real estate requires complex legal processes, title transfers, and physical inspections that create multiple opportunities for government intervention. Recent reporting indicates that the decades-long pattern of Asian capital flowing into American real estate markets has not only stopped but actively reversed, with Chinese entities systematically liquidating properties across multiple markets simultaneously. This coordinated selling reveals the organized nature of the current withdrawal, suggesting that Chinese financial authorities or influential private networks have established clear guidance about reducing exposure to American real estate, regardless of short-term market conditions or potential losses on individual transactions. The urgency driving this liquidation has been amplified significantly by the severe crisis affecting China's domestic property sector, where major development companies have collapsed or entered restructuring processes that threaten the savings of millions of Chinese families who invested in real estate as their primary wealth-building strategy. The domestic crisis has created a dual incentive for wealthy Chinese individuals and institutions to liquidate American real estate holdings, both to reduce overall real estate exposure and to convert illiquid assets into more portable forms of wealth that can be moved quickly if political conditions deteriorate further. This strategic repositioning reflects a fundamental shift in how Chinese elites evaluate different categories of assets during periods of increasing geopolitical tension. Traditional investment criteria, such as expected returns, diversification benefits, and inflation protection, have been superseded by considerations of portability, political neutrality, and resistance to government seizure. Gold, alternative currencies, and investments in jurisdictions with strong financial privacy protections have become more attractive than American real estate or corporate securities, regardless of their comparative investment merits under normal circumstances. The coordination required to execute such a broad liquidation across multiple asset categories simultaneously indicates sophisticated planning and communication networks among Chinese financial elites that extend far beyond formal government guidance. Private equity groups, family offices, sovereign wealth funds, and individual billionaires are all participating in what amounts to the largest coordinated capital flight in modern financial history. Converting American assets into forms of wealth that can be preserved outside the reach of American legal systems during potential future conflicts over Taiwan or other strategic flashpoints. Popular financial commentary has fixated on a dramatic scenario where Chinese leadership could theoretically dump their entire Treasury portfolio overnight, crashing American bond markets, spiking interest rates, and destabilizing the global financial system through what analysts breathlessly describe as a nuclear financial option. This narrative has gained particular traction during 2025 as renewed trade tensions and tariff disputes have escalated rhetoric on both sides, with commentators warning that Beijing possesses the ultimate economic weapon in their massive holdings of American government debt. The theatrical appeal of this scenario obscures the practical realities that make such dramatic action both unlikely and counterproductive for Chinese financial interests. Attempting to liquidate hundreds of billions of dollars in Treasury securities within a compressed time frame would immediately depress the value of those same securities, inflicting massive losses on Chinese holdings before the sales could be completed. Markets would recognize the distressed nature of such selling and discount prices accordingly, ensuring that China would receive far less value for their assets while simultaneously damaging their own financial position. Modern financial markets possess sophisticated mechanisms designed to handle large institutional trades without causing system-wide disruption, and American monetary authorities have demonstrated repeatedly their willingness and ability to intervene when bond market stability is threatened. The Federal Reserve System maintains extensive tools for managing Treasury market liquidity, including the ability to purchase securities directly when market conditions warrant intervention. Any dramatic Chinese selling would likely trigger immediate countermeasures designed to stabilize yields and prevent the cascading effects that such financial warfare theoretically envisions. The reality of Chinese Treasury management reveals a far more sophisticated and ultimately more effective approach that achieves strategic objectives without triggering the defensive responses that dramatic action would inevitably provoke. Evidence suggests that Chinese authorities have favored a passive, methodical strategy that allows bonds to mature naturally without replacement, shifts existing holdings into alternative custody arrangements outside American legal jurisdiction, and gradually reallocates capital into agency securities and alternative investments that provide similar returns with reduced political risk. This gradual approach offers multiple advantages that dramatic dumping cannot achieve. It avoids triggering market interventions that would reduce the value received for liquidated assets, maintains the appearance of normal portfolio management rather than hostile financial action, and allows Chinese authorities to time their withdrawals to take advantage of favorable market conditions rather than forcing sales during potentially unfavorable periods. The methodology also prevents American policymakers from implementing countermeasures specifically designed to neutralize sudden Chinese financial actions. The strategic effectiveness of this approach becomes clear when viewed over the extended time frame during which it has been implemented. Chinese Treasury holdings have declined by approximately 40% over the past decade without causing the market disruptions that sudden selling would have generated, while achieving the core objective of reducing exposure to potential American financial sanctions. This reduction has been accomplished while maintaining access to dollar-denominated markets and preserving the flexibility to adjust the pace of withdrawal based on changing political and economic conditions. The gradual nature of this withdrawal does not contradict the broader thesis that Chinese financial elites are systematically reducing their exposure to American financial systems in preparation for potential conflict. Instead, it demonstrates the sophisticated planning and long-term strategic thinking that characterizes effective financial statecraft. Rather than wielding Treasury holdings as a crude weapon that would damage Chinese interests while achieving limited strategic objectives, Chinese authorities have implemented a systematic withdrawal that reduces their vulnerability while preserving maximum flexibility for future action. This approach reflects the understanding that financial warfare requires patience, precision, and strategic coordination rather than dramatic gestures that generate headlines while failing to achieve lasting strategic advantages.